Hi everybody, this is Gary Dean, and this is our weekend video report for Sunday, May 8th, 2016. Happy Mother's Day to all the mothers out there. And let's get started. So I was kind of warning that, adding new short positions later in the week really wasn't a safe trade because we had some bullish divergences that were forming on the 60-minute charts. They were pretty oversold, and we did see some selling on Friday, but it went right to support where we were anticipating the bulls to step in, and it ended up wiping out the losses and closing up 6 on the S&P. So it's good to see that things are kind of getting back to a technical normal basis. And what I mean is, when we have those drift higher, nothing really matters. You did, technical divergences, support, resistance. It just everything is thrown out the window because you're in this grind higher and things get boring, and then everybody gets complacent. And then once everybody is on one side of the trade, which is the long side, they pull the rug out and they throw out something like we're seeing right now. So we got the bounce. That was great. I still believe there's some more to go on it. Even though we could open up down on Monday, we have to see the way the futures open, but from a technical basis, it would make more sense that if we saw a little more upside than what we've seen so far. So if we just take a look at the block volume and money flow, you can see there were sellers on the S&P as it was rallying on Friday. So it kind of fits the whole. This is a counter trend bounce because once this completes, I do believe the lows are going to be taken out. So we're kind of in an up and then down situation that I'm expecting right now. So if we take a look at our regular charts here, this is the support area I've been showing you, the 2040. That was pretty much right where the low was. We got the bounce. Now we have the bullish divergences. So again, this is telling you that things aren't safe to be shorting right now, adding new shorts. You want them when you have the bearish divergences and it's up here. When it's down here, you start locking in profits or moving to cash, or if you're aggressive, you can go on the long side. But right now, you can see we still have plenty of room to go until we're into the overbought levels. But the bulls still need to get through this wedge right here. So we have the, they're right at the top of it. Even if they break through, they got to deal with this, with the 50-day moving average. That's right at the 2063. And then above that is the 2070, is the 200-day moving average. And then this is your resistance zone. So it would make good sense if we got up somewhere into the 2074, maybe even the 2083 level, shake out some of the weak shorts. And then once this completes, most likely we're going to come down and take these lows out. And really the target area that I would be anticipating on this drop is going to be, anywhere in the range of the, let's say, 1960, 1925, or 1874. So right now you can see that we landed right at the 50-day moving average on the S&P. It broke through it a little bit, but again, this is the support area, so you don't want to be jumping heavily on the short side when we're here, because you're going to get caught on one of those, the short covering rallies. But it found support. If it goes up and then let's say we break through this, really the next area is going to be the 2012. This is really what the panic line is, because if they start breaking through that, now we're breaking through the moving averages, and we could really see selling accelerate down to these levels. But the bears need to push it through this support level before you can even consider these levels coming into play. So there's work cut out for the bulls, there's work cut out for the bears, and we just really have to see how things play out. But the pattern, the longer term pattern, is a bearish rising wedge that we broke through. You can see we have 1, 2, 3, 4, 5. So 5 waves up typically means that you retrace anywhere from 50 to 78 of this entire rally. So this is why I have these targets right here. We're still not even close to oversold right now on the daily. So the fact that we have bullish divergences on the 60 and we have a bullish falling wedge, that is telling me this is the up part of the situation where, or the tape that I'm expecting, where we get a bounce up here. Once it exhausts itself, then we start coming down and taking out these lows, and we start following these bearish divergences that are on the daily tape right there. So if we look at the 15-minute chart, you can see, let me just lower this here. Okay, so what we can see on the 15-minute is, again, we had the bullish divergences forming. So again, the short side wasn't safe. The first obstacle for on the short-term basis is going to be the 2066. If they get through that, then you can start eyeing this gap here at the 2080. And like I said, we're probably going to get a move somewhere up into these ranges here before they roll back over and head back down again. So probably the best way to put things right now is longer term. I think this is just a counter trend bounce right now, and once it completes, we're going to see a move to the downside that's going to take out the lows that we just made. But you have to be patient with the shorting. Let things get exhausted on the upside. Even if they move down on Monday, it's still going to kind of show those bullish divergences. So it's not going to make it a safe environment to be shorting. So I would be patient right now. I'm going into next week expecting a bounce. Once we start hitting some resistance areas, I'll start paying attention to things and finding out where you'd want to build another short position. And until then, I'm really kind of neutral with a bias to a short-term bounce. So with that, let's see what plays out tomorrow. Have a great rest of the weekend, and I'll talk to you guys in the morning.